3:30, 3 o'clock, 3:45 right there. Between 3:15 and 3:45, last hour macro, it will run on liquidity that has not been engaged. Meaning, here's 3:15 New York local time, 3:45. That's your last hour trading the macro. The algorithm will do a spooling. Okay, spooling. Think of it like I got questioned by a few folks about this. When I say spooling, imagine you're a fishing, um, you're holding a fishing pole, okay, and you cast the fishing rod out into the water. When the fishing line is leaving the spool, it's just like it's running, it's dragging out that line. That's what it's going to do. It's going to run out the line like you're standing right here. You're going to cast the fishing pole, and the line keeps going out, and you're aiming for to drop your lure into this area right above here, because right above here is what buy side liquidity. So you could be a buyer trading down here at some random level, a volume imbalance, order block, buying that at the 15 minute after 3 o'clock and expecting price to start delivering higher. And once it creates this scenario, you are entering into a buy program. A buy program is not a market maker buy model. Okay, I see a couple of students interchangeably using that. That's not what's going on. A buy program is when when an algorithm starts going into buy side delivery, meaning it's going to keep booking price higher and higher. It does not matter. Listen, folks, I don't care how long you've been trading, who you know, what firm you worked with, you used to make the markets at so and so's, crude oil option market. You're not a market maker, you're a dealer. When you look at the market from the perspective of the algorithm, was what we're seeing here, and I'm bringing it to you every day. When the market starts delivering price higher, it matters not how much buying pressure there is or how much selling pressure it is. It's going to go there regardless of whether you want it to or not. You could be bearish all you want. Everybody could be screaming about it on the marketplace, sentiment, message boards, forums, Reddit, everybody. It won't matter, because if the market's going to go there, it's going there. And it can do so with low volume, which blows out the whole argument about buying and selling pressure. The market rallies from here and enters a buy program. Buy program is when the market just starts booking higher prices until we get to a pool of liquidity. In this case, it would be buy side here, or a premium inefficiency, which would be an example like this right here, this small little fair value gap. So the difference between this candle's low and this candle's high is a SIBI, sell-side imbalance, buy-side inefficiency. That's the classification of this particular fair value gap, meaning it only offered sell-side. So to be repriced correctly and have an efficient fair value offered to the marketplace between this candle's low and this candle's high, it will want to reprice up to it here like it does with up close candles. The market will deliver it on an up basis. So it's now offered efficiently through the scope of fair value. It is not rebalanced because it did that. That's not rebalancing, it's repricing. When it leaves this range, then it is balanced. Then it's likely to support price where it doesn't need to go back down there. So that's the only distinction I'm going to make here. Now go back to that low. Once it starts rallying, every down close candle or series of down close candles, if there's ever a series of down close candles, you use that entire block of down close candles as one, because it's delivery that you're looking at, not just simply one candle. One candle does not make a narrative. One candle doesn't make a order block. It's this change in the state of delivery that is the order block. What do I mean by that? Let's dig into this. Three down closed candles. That opening price right there. that candle's opening price, you're going to look at this value right here, okay? Look up here in the upper left-hand corner where I'm pointing. That's the open. That price is 4145.75. As soon as that price is traded to and one tick above it, that becomes an order block. So young men and young women, please stop making videos pretending you're teaching order blocks because you have no idea what the hell you're talking about. This change in the state of delivery right there, once this occurs on that candle, this opening price becomes fair value. That means that the market, when it trades through it here, it's going to want to do what? Offer smart money, the traders that some of you don't believe exist. And when it comes back down and touches that, they're buying it. When it trades on this candle here and trades and goes down to it again, they're buying it. Their algorithm, which is high frequency, and it's constantly hammering the market at these price points. They're buying it here, they're buying it here, they're buying it here, and they're buying it here. Every single time we leave a down close candle, they're watching their positions move into profit. Every time that we see a new change in the state of delivery, it's offering them another opportunity to build their position and build it larger. Remember, the focus is over here. This is the draw on liquidity where the market's going to be pulled to. Why? Why should it go up there? Because there's buy side up there. Buy stops. Willing buyers to buy at a higher price when it's down here. Think about that. You're not taught to think like that in these books. Everybody writes these books talking about that's resistance. No, that's victims. That's new meat. That's flesh to be devoured. The market is the beast. It will consume the flesh that is dangling off the carcass right above these highs. That's the life essence of these markets. It's going to where the orders are. It has no respect of your pattern. It has no respect of a down closed candle that you're foolishly calling an order block when you don't know what you're talking about. It's going to where the actual orders are. And inefficiencies. So the market's going to seek liquidity and fair value constantly. It's always this ebb and flow between the two. It's constantly trying to facilitate the most efficient model of delivery for price. That's the function of these price engines. It's doing that. It has no awareness how many contracts are being bought or sold. It has absolutely none. It doesn't even know how many contracts are resting above that. It just knows that once it does this and it stops here and pulls away, every trader is going to do the same thing. It's called priming. Priming is doing something with the expectation that the audience, viewer, or participant will begin to expect a specific outcome. Once that's done, once that hook is sunk in, it's over. The market goes down. When this pass here occurs, traders are going to look at that and say, oh, it's going to take out that low. They want to be short. Selling. Smart money's buying. Changing the state of delivery. Buy. Boom. Displacement. We're taking out a short-term high right here. Now, think. I just walked you through as close as I freaking can without getting in my own personal trouble here. This becomes the 2022 model. Think. Low, lower low. Sell side's taken. We're inside that time window between 15 minutes after 3 to 45 minutes after 3. So that closing hour, final hour of trading, you're going to see a macro run to the liquidity that has not been engaged. That's this over here within the context of a bullish market, which I gave you this morning. Changing the state of delivery, buy. Displacement, shift in market structure bullish. This is where I've been telling you to buy. This is where I buy. This is where I buy. That's where smart money engages. They're in early. How do you know to get in early? Because I know. I'm teaching you how to get in where it's obvious to see it. Isn't that obvious now? That's exactly what I taught you in the 2022 model. Shift in market structure. After liquidity is taken, bias is bullish. We have liquidity. Aim for it. Buy in this fair value gap. Okay. Don't trail the stop loss up real tight. I teach you that in the model. You got to get first profit before you ever roll your stop to anything considered break even or close to that. So are you stopped out here? No. You might be a little unsettled because you're new. That's normal. Market rallies, comes back into another fair value gap here, trades into it, rallies. 2 down closed candles. We trade through it here. That becomes an order block. It's a change in the state of delivery. It's delivering now, buy side. The next candle opens here. What is that? It's a volume imbalance. If it opens here, expect it to trade back down. Just to close that gap to that opening price? No. Trade into this candle, that opening price. Trades into it, smart money will buy there. What happens after that? Rallies. It does not rally because smart money bought. It does not rally because smart money has more buying pressure. It rallies because it's rallying. It's designed and it's coded to do so. I don't give a shit who believes me. Rallies up, and we've priced rather handsomely above the relative equal highs here. Okay. So you see again another final trading day, final hour trading macro between 315 345. What's actually occurring there? I know some of you are asking, like, what makes that macro? What's the deal with that? It's a function that will make the most sense for some of you when you think that the market's bullish and we had a big bull day and it runs up, makes a high of the day, and then usually this time of day the market will pull off the highs and close near the high but not at the high. And by knowing what you're trading in terms of direction, and then you focus on specific times of the day where I'm teaching these macros exist, the 15-minute mark to 45 minutes after 3 o'clock New York local time, that macro is market on close. It means it's going to cause a price run as we get in towards the end of the day. If you do not have a clear setup and it's not obvious, you do nothing. You don't do anything, and you just wait for 20 minutes to 15 minutes before 4 o'clock, and then you'll get some kind of a 5 to 8, maybe sometimes 10 handle run. That's how I trade the last final hour trading. It's so systematic, it's so generic, it's so boring. But for a trader that's looking for continuity, something that repeats over and over and over again, it's hard to beat it. Like, it's really difficult to find something that would be easier. Even though it sounds too scientific, it sounds like there's a whole lot of conjecture here. If you've been with me for a number of months, you hear me saying the same things. And you see your chart printing exactly what I taught you it's going to do. Because it's coded to do that. You're not going to convince anyone in this group that this isn't algorithmic, that it's absolutely controlled. Because they've been witnessing, they've handled it, they've seen it. And I know it's jarring to some people that maybe work in the financial realm here in trading, and maybe you're at a brokerage firm, maybe you're at a quote unquote bank, maybe you're at a trading institution, okay, something to that effect, and you only know what they trained you to perceive price as. So you're indoctrinated. I'm on the other side. I've been where you're at. I'm on the other side. I'm telling you how these markets are booking, and I'm proving it daily with every single 1-minute candle. If it wasn't algorithmic and I didn't know what the hell I was talking about, it wouldn't work, would it? Then if it ain't that, then I figured out the code of buying and selling pressure, right? It's ridiculous. It's not that. It's not that at all. And when people just simply relax and disarm themselves and just warm up to the idea that this is a benefit. If the market is rigged, which it is, there's no reason to fear that. But you should fear over trading, over leveraging, pushing a mythical edge that you think exists with retail stuff. Because when you make money, it has nothing to do with you doing something right with a pattern. You just happen to be on side at that time and use proper money management. The money management is what made most people profitable, not the actual trading. Because if you sit down with most retail traders, even the ones that do really well, and well means they make a lot of money, not just making their ends meet. They make a lot of money. If they're honest, they'll tell you that their strike rate's really low, and it sounds shocking to the average person, to a lay audience member. They're like, "There's no way you're making all that money and your strike rate is that low. Surely your strike rate has to be extremely high." No, the money management does all the heavy lifting. They know how to cut losers. They know how to lose. They know how to take the losses and not go nuts about it. And they let their runs run.